Orient Electric Q3FY23 earnings conference call hosted by PhillipCapital India Private Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star, then 0 on your touchtone phones. Please note that this conference is being recorded. I now hand the conference over to Mr. Deepak Agarwal from PhillipCapital India Private Limited. Thank you, and over to you, sir.
Thanks. Good morning, everyone. On behalf of PhillipCapital, I welcome you all to Orient Electric Limited Q3FY23 earnings conference call. Today we have with us senior management represented by Mr. Rakesh Khanna, Managing Director and CEO, Mr. Saibal Sengupta, Chief Financial Officer. Without taking much of time, I will hand over the floor to the management for their opening remarks, post which we will open the floor for Q&A. Thanks, and over to you, sir.
Thank you, Deepak. Good evening, everyone. A very warm welcome to all of you, and thank you for joining us for our Q3 Financial Year 23 results discussion. I am Rakesh Khanna, and with me I have our CFO, Mr. Saibal Sengupta. We are pleased to share that the company registered record high revenue for the quarter with a growth of 8.9% year-on-year to rupees 739 crores in Q3 Financial Year 23, owing to growth in the ECD and lighting and switchgear segments. Our 3-year CAGR for Q3 performance is 14.2%, while the 5-year CAGR is 16.4%. The gross margin was 28.6%, improving by 234 basis points quarter-on-quarter and 102 basis points year-on-year, driven by better cost savings initiatives. The EBITDA margin registered a decline of 237 BPS year-on-year, partly due to one-time costs on account of investment in growth, but grew by 515 BPS quarter-on-quarter in Q3 Financial Year 23 to 7.4%. Although pricing pressure and high-cost inventory weighed on margins, better operating leverage resulted in expansion of the EBITDA margin on a sequential basis. Excluding one-time costs, the normalized EBITDA would have been 9.1% in Q3 Financial Year 23, a modest decline of 17 BPS compared to Q3 Financial Year 22 normalized EBITDA. The profit after tax margin was 4.4% in Q3 Financial Year 23 compared to 5.6% in Q3 Financial Year 22. Our working capital improved to 20 days in the quarter from 34 days in Q3 Financial Year 22. The increase in revenue to a substantial extent was supported by 11.9% YOY and 73.8% Q-on-Q growth in the ECD segment, led by fan and air coolers. The fan segment recorded the highest Q3 sales ever, which increased by 15% year-on-year, following aggressive restocking by trade channel ahead of BEE star rating implementation from January 2023. The current restocking of fans combined with severe cold weather in the north may cause some temporary blips in trade takeoff in the coming months, but we expect the trade to normalize as soon as consumer offtake starts in February-March. The EBIT margin for the ECD segment was 12% for Q3, registering an increase of 755 BPS quarter-on-quarter and an increase of 89 BPS on a year-on-year basis. The company has been able to sell its entire non-star rated fan inventory amidst BEE transition. Presently, we have upgraded 350 plus SKUs from non-star to star rated fans and have attained B rating certification for 400 plus SKUs. The company has position in the BLDC fan segment with its established product portfolio, further supported by a planned rollout of new SKUs in quarter 4. In quarter 3, air coolers registered a 2x sales growth Y-on-Y, while water heater sales grew by 21% Y-o-Y, supported by a 2.5x sales growth in e-commerce compared to last year. We are happy to share that our direct distribution strategy has generally stabilized in states of Bihar, UP, Odisha and Karnataka and has started yielding positive results as sales in these states grew by 60% in Q3 financial year 23. Andhra Pradesh and Telangana, the two states which came in later, still had to stabilize and yield positive results, and we expect them to stabilize by quarter 4 financial year 23. Our focus is on the expansion of distributors, direct dealers and retail touchpoints in these states. The lighting and switchgear segment recorded year-on-year revenue growth of 1.6% for quarter 3 financial year 23. The overall lighting growth was stagnant in quarter 3 financial year 23 due to the pre-placement of demand in Q2FY23, GST increase, and the diversion of liquidity towards stock filling of non-rated fans by trade channels. The growth in the B2C segment remained flat due to subdued demand and high base of last year. The B2B segment grew by double digits year-on-year, driven by infrastructure spending and robust growth in the facade lighting space. Further, EESL restructuring is complete, and we expect tender business to improve in line with government's infrastructure push towards highways, airports, railways, and smart cities. The professional luminaire space saw record revenue growth with high teens year-on-year growth and improved margins over last year. The company has successfully executed multiple projects for NHAI in Chennai and Chhattisgarh, UP Street Lighting, HPCL, Jaipur Development Authority, and Delhi PWD. Further, the inquiry and execution levels in the building facade lighting segment remain healthy. The company has successfully completed 3 projects: the Ganga Barrage project, the Varanasi Kent railway station, and the Puducherry Smart City project. We continue to make progress on Srinagar Smart Lights project, and our company has been awarded the prestigious contract to design and provide facade lighting for Baroda Bhavan in Delhi. The switchgear segment continues to grow with healthy traction in the mass premium segment. We have also launched house wires in 6 states, namely Rajasthan, Haryana, Delhi, UP East, Bihar, and MP during Q3 financial year 23. The company's exports grew by double digits despite the eco-political challenges in key markets, Sudan, Sri Lanka, Ghana, and moderating demand because of monetary tightening in the Western markets. We remain focused on driving the growth through lighting and switchgear portfolio, increasing the digital revenue, go-to-market strategy, and cost reduction initiatives. We have augmented our leadership across various functions to expand our market, brand, and segment outreach. On the Sanchay project, we have achieved 37 crores in cost saving till December 22. Our new Greenfield Hyderabad factory's construction is on track, and we have incurred rupees 38 crores in 9 months financial year 23 out of the budgeted rupees 175 crores till date. That is being funded out of internal generation. We continue to expand our digital revenue, which witnessed 3x growth in quarter 3, although on a low base. In the quarter, the lighting category in e-commerce witnessed improving traction on the platform. In the quarter, we were awarded the CII Supply Chain and Logistics Award for 2022 along with the FAME India Safety Excellence Award and the FAME India Environment Excellence Award in the consumer goods electrical sector category. With this, I would like to open this forum for question and answer. Thank you.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Aniruddha Joshi from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity. Sir, now considering the direct-to-market route, what is the total sales of the company coming via direct-to-market route? And what is the total potential left? Means what is the total scope to do the investment in expanding the depth and width of the distribution for the company? And again, secondly, what are the total savings that the company has achieved from direct-to-market route? Yeah.
Well, Anirudh, as I said last time also, the total potential that we have addressed through direct-to-market is around 25%. We are now significantly gaining in that side. We are coming closer to our average all India market share. In some parts of the market, now we are even higher than the average all India market share that we have. The kind of experience that we have gained in the direct-to-market is a great experience, and we feel that we can continue to further expand and take the market share in these states to the highest market shares that we have in any of other states. So it's a great experience that we have. Idea is not to do cost savings. There are no cost savings involved. But there are no extra costs also. It's cost neutral by and large. It is only about setting the best ground rules from zero base in these new states and creating the best practices. That's what we are gaining.
Okay. Thank you, sir. And sir, second question. Considering the entire industry has seen good sales in Q3 itself of non-rated fans, so do you see any likely impact that the industry itself may have relatively muted growth in Q4 as well as Q1?
There would be some kind of an impact, but I see this to be a small impact. Really speaking, if you see the entire industry, the growth in Q3 is not so great that it's likely to impact Q4 and the coming Q1 and the season. It's a small growth that has happened. It's a small trade pickup that has happened. We should not forget that the channel was also reasonably empty in the last few months and maybe 2 quarters. And therefore, so much of pickup is not likely to seriously impact the trade going forward. And I personally believe that as soon as the consumer offtake will start, the trade pickup will again become normal very quickly.
Okay. Thank you, sir. Very helpful.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. We have the next question from the line of Bhargav Buddhadev from Kotak Mutual Fund. Please go ahead.
Yeah, good morning, team, and congratulations on a good performance. So my first question is on the fact that wherever you have seen direct to market, you've also rolled out DMS and SFA. So what are the key benefits of this which you are seeing, and is there a probability of this seeing a pan-India launch also in the fan market for us?
Yes, Gaurav. What the digital DMS and SFA allows us is to have a complete visibility. Our objective is to reach the last mile where the consumer buys from the customer, from the retailer, and we would want in every state to have a retail viewership of at least 2,000 to 2,500 every state. That's the target. How this helps us is to ensure that the counter shares on each of these addressed retailers are well managed and well influenced. A retailer is an important customer for us in that sense, and we would want to ensure that the retailer is very well serviced. And this visibility helps us to ensure that every retailer is well serviced and our reach is correct. And finally, that is what leads to good market shares. We will be rolling out a similar DMS in the other states also. But let me clarify, we will roll out the DMS and SFA for the transparency in other states and not necessarily the direct to market.
Sure. Understood. Secondly, sir, just wanted to know how has been the pricing for these star-rated fans. What we're hearing is that the same have been priced very competitively compared to the non-star-rated fans, and hence the consumer demand may not be significantly impacted. Is that assessment correct?
Yes, you are right. Although the cost increase is there, we are working hard to ensure that the impact is minimized through a lot of cost reduction initiatives, through pricing initiatives, and we understand that we do not want the consumer to get significantly impacted.
Okay. And so last, this data-related question, you mentioned adjusted EBITDA margin of 9% plus. What was this one-time cost, and can you quantify this? That's my last question.
So there are a few one-time costs.
So, Bhargav, I will take that question. Basically, there were one-time costs around, as you have seen, our employment costs have gone up. So there were a lot of senior management recruitments which have happened. The one-time recruitment costs have gone up. Then we are doing this McKinsey project, which was not there on the base. That has added to the increase in the costs. And as well as, though it is not one time, but still in terms of advertisement promotion, we have significantly upped it on a year-on-year basis. All that put together has caused this impact. I'm not talking about the other normal expenditures which have rolled back to pre-COVID levels, including international travel and all that. I'm not regarding that. But yes, one time comprises of the McKinsey consultancy and recruitment costs. Those were the bigger ones. Plus together with the advanced brand investment. So all these, we look upon it as an investment for long-term sustainable growth.
So, sir, can you quantify the McKinsey cost and the ad spend as a percentage of revenue?
We don't give that kind of a detail, but all that put together, if you can estimate around 1.7, 1.8%, all this put together.
Okay, sir, this is helpful, and all the best. Thank you very much.
Thank you. The next question is from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
Hi, sir. Thanks for taking my question. Please, can you talk about a little on the secondary sales, how it has moved? Because the large part of your volumes and large part of the ECD portfolio is still fans, where you have done the inventory addition. Plus, there was a change in states, direct to marketing, which could have also resulted in the high inventory and pushing the volumes to the dealers. Can you talk about more on the secondary sales, and as we are closer to the Jan end, how the secondary sales is moving? If you can throw some light on that.
The secondary sales are in line. They're quite satisfactory. From whatever we understand, the market also, the secondary sales there's no growth that one can talk about, but it's not small. So secondary sales are going well. Consumers are buying. We're just waiting now for the summer to come up when we will see a spike in the next level of sales going up.
Getting it. And the change in the distribution which you have done, any other states which you will be taking going ahead, or is it largely done, the first 5 states which you have gone through?
See, currently, we will be focusing on just putting these states absolutely right. And we will be putting the learnings in the other states. As I said, there are some great learnings that we're coming across. However, we will always be open to taking any decision anytime. What is important is whatever is most suitable in a given state, those actions will be taken in the interest of the market shares in the state.
Getting it. Just one clarification on this cost element. So the employee cost, which is 57 crores now, generally we have been in the range of 46 to 47 crores or 45 crores. In that, how one should take the recurring cost on the employee side? Because you said there is some recruitment cost. I didn't understand what is this one-time recruitment cost. I mean, it should get normalized, right? So can you throw some light? What is the normalized employee cost one should assume?
So maybe Sagar can take this question.
Yeah. Hi, Nitin. Basically, the employment cost which has gone up, this you should see it as a recurring cost because now most of the quite many of the senior management team members have already been onboarded. Their costs are coming. 1 or 2 will get added in the current quarter as well. So what is published is the recurring cost, and it will slightly increase as well. The recruitment cost which I talked about is the one-time recruitment for the not only senior management, for at all levels. A lot of vacancies are also getting filled up at the junior levels as well. All that put together is a one-time recruitment cost.
Okay.
So let me also add, the way you need to see it is that all of these are upfront costs for the future growth. And as we start growing, you will start seeing the advantage of these costs. So you can see them, the increase in the cost is an upfront cost, which we are putting in building some part of the organization, which is a growth lever of the organization. For example, we are building a very strong e-commerce team. Now we know that this is an area where we want to significantly grow. So in future, as a percentage of revenue, you will start seeing it coming down.
That's a well point taken, sir. I was just trying to understand that, where this 170 bips coming from a one-off. So it doesn't look like a one-off. It's the recurring cost, and I understand the future benefits will come as a percentage of sales. So on an absolute basis, I was just trying to understand that we should assume this number or not. So then it doesn't look one-off. That's what I was trying to understand.
The one-off is the other recruitment cost, which is in other costs and not in the salary.
Not in that. That would be 8-10 crores roughly.
Difficult to say.
Difficult to say. Got it. Thank you very much, sir. I'll come back in the queue. Thank you.
Thank you. The next question is from the line of Rahul Gajare from Haitong Securities. Please go ahead.
Yeah. Good morning, gentlemen. Sir, I have a question on fans. Now, you did indicate, that fans have grown by about 15%. Could you clarify the volume growth that you've seen in this quarter and for the first 9 months for the fans business?
Volume growth, value growth are nearly similar.
Okay, fair enough. Now, lighting, I was looking at similar volume growth in the lighting business. Because we've been flattish in this particular quarter, but in the full year, in the first 9 months, we've seen a 20% plus growth. So just want to understand the volume growth in lighting business.
In lighting, it is very difficult to give a volume growth. It's comparing 2-3 very different products. On one side, you have street lights. On the other side, you have a bulb. So very difficult to put the volume to value. I think one has to see only value.
Okay, let me put it in a different way. I understand there is some decline in the realization in the B2C lighting, some large part of the lighting. Is there a significant decline in realization that we've seen in the B2C lighting?
No.
Okay. So my last question is, on the demand scenario and what you've done on the e-commerce, to see a significant jump up. That's the last question. Thank you.
Sorry, your question is not understood.
So I'm asking on the demand scenario. We for last 2-3 quarters we were talking about a slower demand that is being seen in the consumer side. So I want to understand what is happening on the demand side on both ECD business and the lighting business.
So the demand is not a high growth demand. I would not call it that way. But also there is no kind of a reduction. We're not seeing the demand is going down. I think it's fairly stable demand. And going forward, we are more hopeful about the demand to further pick up.
Right, sir. Thank you.
Thank you. We have the next question from the line of Nikunj Gala from Sundaram Asset Management Company. Please go ahead.
Yeah, good morning, everyone. So just want to understand in the last 1 month, what are the consumer behavior we have seen in the fan category? Like, still people are preferring buying 1-star, 2-star, or 3-star and above. Can you just help us with your, understanding from the ground? What is the higher contribution from which star?
So currently, this will be a lot influenced by the trade. And in the trade, since there is a 0-star material, the trade will continue to push the 0-star fans. But going forward, as this inventory will deplete and the awareness of the star-rated fans will increase, it's very clear that the consumers will start going for the star-rated fans.
So in the last month, we haven't seen any pattern of people moving from 0-star to 3-star or something. So you must be having some order, backlog, for the coming months.
No significant shift as of now, as I said, and This is largely also driven by what the trade has stocked, because the consumer first has to go to the retailer and speak there, and the retailer will show the stock that the retailer is carrying, and therefore not a significant shift.
Okay. So as of now, just want to understand from your production perspective, how the contribution will be from your production side. Like large chunk would be still you would be producing 0 and 1-star?
No, there is a legal requirement, and effective 1st January, the manufacturers cannot manufacture or sell the 0-star.
Yeah, I mean for 1-star and 2-star, sir.
Yeah.
I'm saying large chunk of your production still will be 1-star and 2-star, sir?
Oh, okay. Still will be 1-star.
Okay, thank you. And just one clarification on your comment when you mentioned in the 9-month period in fans, your volume and value growth are equal. So in the last 9 months, considering the kind of inflation we have seen, is there understanding that we haven't taken any price increase in the first 9 months?
A lot happened because of the mix change. During this time, because there is a lot of stocking that has taken place, a lot of it has been on the lower price side. So it's a mix change.
Okay. Thank you. Yeah, thank you, sir.
Thank you. The next question is from the line of Rahul Agarwal from InCred Capital. Please go ahead.
Yeah, hi. Good morning, Rakesh ji and Saibal ji. So 2 questions. Firstly, our interactions during last quarter with the trade essentially indicated some kind of higher discounts and schemes for liquidating 0-star. Your one-time cost, whatever you mentioned, doesn't include any kind of cost related to that. Could I understand a bit more exactly how was your experience in terms of liquidation? Did this discount thing actually impact margins? And what would be the receivables really? Because if I heard correctly, you said net working capital is actually better YOY. So just these 2 things, please.
Yeah. So the good thing that happened with us is that we cleared the inventory and we planned well ahead of time. And therefore, by December itself, we had sold most of the inventory that we had. We were not under any pressure to discount to liquidate our inventory. We were much better off. And in terms of the credit, you would have seen our working capital. The stocks have improved, receivables have improved. I think we had done very healthy selling. We are happy for that.
Got it, sir. And the second question essentially was on margins. So it looks like obviously 3Q has been better based on past history purely because of channel filling on fan side. But the gross margin and operating margins have not really reverted to long-term averages. Obviously, that's a function of some one-time cost incurred right now. But how should we look at margins, sir, over the next 12 months? Any indication, any direction will be really helpful. Thank you so much.
So in terms of gross margins, we have improved our gross margins. Of course, the pressure continues. There is a lot of competitive pressure in the market, but we have improved our gross margins. Going forward, we do hope that our gross margins will further come up. There are a lot of cost-saving initiatives that we have worked in the pipeline. They will help us to improve our gross margins going forward. And we have not put any separate one-time liquidation costs. You see, the entire pricing is a part of the total pricing in the gross margin. So there is no separate thing called that there is a liquidation cost for those and it's sitting somewhere else. Nothing else is sitting anywhere else. It's the total gross margin earned is what it reflects, which has improved.
So the EBITDA should improve to 9-10%, or will it take like real time because we're investing quite a lot on on e-commerce, on people, on a lot of other things, right?
Yes. So we expect the whole thing to start giving results fairly quickly. As you noticed, when we took the call of go direct to the market, our lesson was that we recovered this. The whole thing came back in a matter of 2 to 3 quarters. So the whole GTM is a 3-quarter cycle. Most of these also should start showing results fairly fast. We're already seeing in e-commerce 2x and 3x growth, which is already coming. I'm sure this will stabilize and will continue to give us the benefits. So the Spark projects in which we have McKinsey working with us is also a 2-year project, of which 1 year is going to get over soon. And we're already seeing the kind of benefits that it is bringing in. And that is what is helping us maintain our margins. And with that confidence, I'm saying that the margins will further grow because these kind of very scientifically done cost reduction initiatives are really showing good results. So we should be seeing the profit margins improving in the time to come.
Thank you so much for answering my questions. All the best.
Thank you.
Thank you. We have the next question from Mr. Achal Lohade from JM Financial. Please go ahead.
Yeah, good morning, sir. Thank you for the opportunity. In terms of the the mix, can you help us with respect to the fans mix in terms of premium and non-premium for 9 months or 1 year?
See, I have always maintained that the premium way we define is very different than the way industry defines. For us, the premium is the top 10%, is what we call premium, and we continue to change the definition of our premium. Our premium is not a fan which starts at 3,000 rupees. At one time, it was 3,000 rupees. Today, it is 5,000 rupees. Anything less than an Aero series, we don't call it a premium. All I can tell you is that the premium is continuously increasing. It is in the range of 10%. With the new 5-star now coming in, the definitions will once again change. A lot of premium will come in the decorative segments for us, and the premium will once again move upwards. But in the premium category, as we define, we are clearly a dominant player with more than 40% market share in this particular segment. I'm glad to say that when it comes to aspirational products, Orient is by far the leader in the aspirational products.
Right. If I were to ask in a different fashion, if you were to, categorize fans in terms of 3 or 4 buckets, what would they be and what their mix would be as we speak?
So the way I would look at it is, one is the basic white and brown fans, and we call them the base fans. The second would be the decorative fans, which have the trims, metallic colors, etc. The third will be the premium fans, and the fourth will be the BLDC fans. And then will be the TPW fans and the exhaust fans. So it's a little different way of looking at the product category, but I think coming out of a pure trade-based, price-based categorization, I think if we see it from the consumer perspective, the buckets will change, and that's the way we place our buckets.
And what would that mix be, sir? Approximately?
The basic fans, the white and brown fans, will still constitute approximately 50% of the total business. And then will be a 10% for us will be the premium fans, and today the total BLDC will be in the range of another 10%, and the balance would be the decorative fans.
Right, understood. The second question I had was in terms of the season. Is there any possibility of a price change, whether upward or downward, for these 2 categories? And B, any new SKU or differentiated product or new product in this particular categories?
Which category?
Fans and air coolers, sir.
In view of the season.
From the season perspective, from the upcoming season perspective.
So the pricing is already announced. The pricing, there is not likely to be any change. And in new products, yes, in fans there is definitely a strong rollout that's happening. And in coolers we have a very strong lineup. So yeah, in both of them the lineup is strong, and prices have already been announced.
Got it. And just one last question, if I may. With respect to the gross margins, you said the cost savings initiative. I think you mentioned 37 crores. I don't know if it pertains to only raw material cost at the gross margin or the other costs as well. So what is the target here? Is there any particular number in mind? What you aim to achieve every year, or is this just a one-time thing?
Yeah. So the target is in 12 months' time, including this, we should be able to save 100 crores. That's the target. And we'll be moving fast towards that target.
And for how much have we saved for 9 months, sir?
As you said, 36 crores.
So you're saying the fourth quarter would alone have 60 crore plus savings? Have I got this number right?
No. We talk of 12 months, rolling 12 months. So
rolling 12 months. Okay. Okay. Sorry, my bad, sir. Understood. And just in terms of market share, if you could help us in terms of fans, lighting, and air cooler.
Actually, we normally do not talk much about market shares because there is no very reliable syndicated data on market shares. So if you ask me, my understanding of market share, depending on which brands and how many players do we take in, counting that bucket, I think if I take all the well-known brands into account, then our market share in fans would be in the range of around 18%.
So I presume you're talking about 18% of the organized market, right? Effectively?
Yeah. So let's not get into market share because there is no syndicated data, and it's very difficult to define what is an organized player, what is an unorganized player. There are different perspectives to them. What's important is this is our market size, and you can compare with the size of other peer group and arrive at your conclusion.
Got it, sir. Thank you. I'll come back in the queue for follow-up. Thank you.
Thank you. Ladies and gentlemen, we request you to please limit your questions to 2 per participant. The next question is from the line of Balasubramanian A from Arihant Capital. Please go ahead.
Good morning, sir. Congratulations for a good set of numbers. I have one question on lighting and switchgear segments. Sir, like we are doing projects, Srinagar Smart City project. And sir, how we are selecting the projects? What is the minimum criteria in terms of margin or IRR and other criteria? Could you please explain the same? Thank you.
Yeah. So when we select the projects, basically we are looking at margin and payment securities and payment terms. So if the payment terms are secure and the margins are good, we take up the project.
Sir, any particular minimum criteria like?
I would not be able to answer that question because that's competitively sensitive. You can understand.
Fine, sir. Fine.
But yes, we want healthy margin and we want to ensure that our payment is well secured.
Fine, sir. Sir, on the ECD segments, like could you please share breakup for fans, water heaters, air coolers? So that would be really helpful.
Fans, water heaters, ECDs. So basically, the fans, as I already mentioned earlier, it occupies around 61-62% of the business, and that is continuing. The water coolers and water heaters, again, the same trend as I had mentioned earlier, between 10 to 12%, that trend continues. As you can understand, there will be seasonal blips into this. And then as far as lighting switchgear is concerned, 27-28%. So this organically, this is a trend which has continued, and the same trend continues in the quarter 3 as well.
Okay, got it, sir. Thank you so much, sir. That's it from my side.
Thank you. The next question is from the line of Ashish from Infinity. Please go ahead.
Thank you, sir, for taking my question. Sir, couple of questions, sir. One is that as this transition happened and the dealer refilling inventory happened, do you believe that some of the sales this quarter were one-off kind of, or do you not think that that's anything there?
If you see the total sale in the quarter, it is not very high.
Right.
And therefore, I don't think it is wise to say the sale is one-off. Yes, the retailers, depending on the geography, have tried to overstock a few fans models, specifically the lower end, where they expected the fans are highly price sensitive. But the total stocking is not very high, and therefore I do not see much impact in the coming quarter.
Right. And secondly, sir, in terms of the slightly longer term and more of medium term, where do you think our EBITDA margins could stabilize? Could we get back to a double-digit, low teens kind of margins, or maybe in a year or 2 years? Or do you think that, because we went through a lot of pain in the last 2 years in terms of market disruption, commodity prices, etc., I presume a lot of that is behind us.
Yes, and if you see, if you take out the one-time investments that we are putting, we are already fairly close to the double digits. So yes, we are very clear that we will be hitting a healthy teens in some time as these one-time costs will go away and leave behind the benefits that these one-time costs will give us. All the benefits that the one-time costs are going to give us are going to be ongoing basis, long-term benefits. And once the cost is removed, you will see healthy EBITDA margins.
Sure. And secondly, sir, on the other income side, is this a sustainable or is there a one-off in that other income?
No, other income has a one-off, which you would have seen the disclosure that we have given. There's a past due which was already fully provided for earlier 4 or 5 years back from one of the distributors for which we were into a litigation. That has got close to a one-time settlement, and that is a provision reversal which has got done, which is from an accounting perspective, it has been disclosed as other income. So that's a one-off. So out of the 8.5 crores that you see, 5.75 crores is a one-off, which has been disclosed separately in the results.
Sure. Okay. Thanks a lot, sir, and wish you all the best.
Thank you.
Thank you. Participants who wish to ask a question, they press star and 1 on their touchtone phones at this time. The next question is from the line of Saptashri Chatterjee from Centrum PMS. Please go ahead.
Good morning, sir. Thank you for the opportunity. My question is on the direct to market. Our revenue contribution from these 4 markets would be closer to 10%, or it would be around mid to high teens?
It is more. As I said, we have addressed maybe 25% of the potential, and now we are fairly close to the average market shares across the country.
Okay, sir. Actually, the reason I'm trying to understand is basically if I back calculate, then for the rest of the markets is like it is kind of a single digit kind of a growth. So what would be the reason for the same? And if that is the case, then is it not good that we very accelerate our pace and do this direct to market across other states?
First thing, you will have to double click on your calculation, because I have also said that AP and Telangana today have not given us the growth. The growth that I said 60% is without AP and Telangana. Having said that, you are right that the growth that we would expect from direct to market states is high, but at the same time we have the states where we are already very strong, and they are with our normal MD operations. I maintained it that our MDs are a very, very strong strength and a great asset that we have with us, and we really value those relationships. Will there be some other states with low market shares where we may take advantage of the learnings of this? Answer is yes. We will see as and when it is required. However, we will also be implementing the learnings from these direct to market states into the MD states and try and further take up the shares in the MD states also.
Understood. Very, very helpful. And can you please give the breakup of revenue mix between B2B and B2C in lighting?
B2B is around 10 to 15% of the total lighting portfolio.
And what would be the margins differential between B2B and B2C?
Margin differential is nothing, because it's at par, because we do not have investments and other costs sitting. There would be a small delta in the gross margin, but that trickles down to the EBITDA, which is at par in both B2C and B2B.
Understood. Very, very helpful, and thank you so much.
Thank you. The next question is from the line of Akash Javeri from Perpetual Investment Advisors. Please go ahead.
Good morning, and thank you for the opportunity. My first question is that once destocking is complete of non-star rated fans at the trade level, and we stock the channel with star rated fans, how do you see the market changing, especially with respect to BLDC penetration, and how does that change our profitability as a company?
Difficult to say how the market will behave, but we can draw parallels from other products that have moved similarly from non-star to star-rated product categories. Water heater being one of them, air conditioners being another one of them. We see that the consumer tends to settle between the two sides On the lower side is the price sensitive side, and on the higher side is the saving side or the efficiency side. Similarly, in this fans category, we see the 1-star will be the price sensitive side and the 5-star will be the power efficiency side. And somewhere in between the two, the consumers will settle. Fans being more a price sensitive product, the upfront cost is critical for a customer. A significantly large portion of customers will tend to settle for the upfront low price product category, which will be 1-star. But a significant side would also move towards the 5-star. We will all see how the market pans out. But the current growth in 5-star is very healthy. It's moving at a fast pace. There are some states which are already showing the BLDC fans in the rate of 25 to 30% market share already. Whereas there are many other high volume states which are slow starters. They have not picked up the 5-star fans very fast. So we will see how the total grows.
Got it. Thanks.
Both sides with good portfolio.
Sure. And what would be the impact? What impact can companies like Attenborough and Superfans, who focus mainly on BLDC, what impact would they have on the industry as a whole?
So you're right that for some time there was a unique position for a few of the players, and they were enjoying a separate space for themselves. But as the whole space opens up and all players will tend to come in that space, it will become crowded. It will take different shape. So we will see how it goes. But I can tell you one thing: the margins are more or less similar as a percentage. What you can be expecting is the market to grow in revenue terms, because if the average selling price of the fan goes up by even 10%, we will see that kind of a revenue growth. And also, if we start seeing replacement happening because of awareness of high efficiency, that will also give us growth. So this B-star rating change is very likely to give a growth to fans and give it a new life, give it more involvement from the consumer side, and we all should see a very healthy fan industry in time to come.
And do we see the cost of BLDC fans coming down? And if yes, by how much can it come down?
Anybody's guess, but I can tell you electronic products have the tendency of constantly coming down in cost. BLDC would be categorized as an electronic product because a significant cost of the product is electronics, and this will continue to come down. Over the last 2-3 years, we all have seen a significant reduction in the cost of BLDC fan, and that's going to be another reason for BLDC adoption to go up, because the price difference between induction and BLDC is likely to continue to narrow down, and we will therefore see an upswing in this, and that will lead to replacement demand going up and the average selling price going up.
Got it. And if I could just squeeze in one more question, what are the advantages of keeping manufacturing for fans in-house versus outsourced?
The make versus buy decision is based on a few things. Number one, how critical is the quality and cost in that particular product category? If we believe that technology is important and it requires investments, then this should be in-house. If we believe that there is the technology can be very simply duplicated, then it can be outsourced. The organization has to see where the organization wants to put the bandwidth of the organization. If it can be, if whatever can be purchased at a low cost from outside without affecting the design or the quality or the cost capability, then it can be outsourced. Otherwise, it has to be in-house. So it's a little complex decision, but we constantly keep on evaluating and taking the decision. I can also add that manufacturing is definitely very important, and it is reflected in our decision for setting up a completely greenfield project in Hyderabad. What we want to achieve from Hyderabad project is a top-class manufacturing facility which will give us technical ability to produce high-quality products with high reliability at an economical cost. So we will continue to take make versus buy decision. It's a great question that you asked.
Thank you so much for answering all my questions, and all the best for the future. Thank you so much.
Thank you.
Sorry to interrupt before taking the next question. I would just like to correct, I mentioned B2B as 10 to 15%. At the end of December, it is 25%. I just would like to correct that. Sorry for that. Please continue.
Thank you. The next question is from the line of Rahul Agarwal from InCred Capital. Please go ahead.
Just one question on this Hyderabad Greenfield project. My sense is it's going to come in phases. We're spending about 175 crores. Could you just give us some kind of understanding when does it start, and some idea on phase 1, phase 2? What are the kind of asset turns or sales contribution or products? I think you've explained in the past. How do you want to ramp up fans? It's all premium, top class, low production. But just phase 1, phase 2, what kind of products should we see? What kind of sales should we expect from this 175 crore investment?
So the initial investment, I would say the large part of the investment, of course, goes in land, building, etc., and then is in terms of equipment. The equipment, because it's the tail end, will come in smaller phases, but that doesn't really define the phases of the whole project. Initially, we will take up all our TPW fans there, and we will significantly reduce the Calcutta production and take them here. One of the reasons for taking TPW here is that we would like to focus on the export market with TPW product, and we believe that market is large. And in India, the ability to produce good TPW at that cost and quality is low. We have to fight with China as an alternate, and this factory will give us the footing to deliver that kind of a product at that cost. We will also be looking at manufacturing the BLDC fans over there, although we have the capability within Faridabad factory also. But we foresee that BLDC fans as a percentage will start expanding, and that's what is going to grow more. That will also come there. This is about the phase 1 where we're talking about the fans. There will be a phase 2 in which we will decide to start manufacturing other categories beyond fans, and that we will share as soon as we finalize. But there is significant space left for that.
Just a clarification, that phase 2 which Mr. Khanna talked about is not part of this 135 crores. This 135 is exclusively for fans, both TPW and ceiling.
Oh, okay. Got it, sir. So phase 1 essentially is FY24, right? I mean, next 12 months, we're all talking about phase 1. Phase 2 will come like 2-3 years afterwards. Is that the right understanding?